On April 2nd, 2025, the president stood in the Rose Garden and announced the most sweeping tariff policy in a century. The world was watching, and for the next 6 days, the story that spread on the news, on social media, at the dinner table, was that foreign governments would negotiate him down, that China would blink first, that the trade partners would come to the table. They were wrong. By day 9, the 10-year Treasury yield had moved more violently than it had in any single week since 1981. The president himself told reporters the markets were getting, quote, a little bit yippy. That same day, he paused. Nobody told you why. By the end of this, you will understand the exact mechanism that forced that pause. Not the diplomatic story, not the trade war narrative, but the structural tremor that moved directly through the bond market and into your mortgage rate and your retirement account. You will understand what $1 trillion of borrowed leverage looks like when it begins to collapse. You will understand why the world's safest financial market temporarily ran out of buyers. And you will understand why, when that happens, the person who pays is never the fund that built the position. It is always you. This is not a political story, it is a structural one, and the structure runs directly through your life. To understand what happened in April 2025, you have to understand what the Treasury market actually is, not the Wall Street version, but the version that touches you. Start from 1971. That is the year President Nixon untied the US dollar from gold. Before that, every dollar in circulation was backed by a fixed amount of gold sitting in a vault. After 1971, it was backed by something else, the full faith and credit of the United States government, which meant U.S. Treasury bonds became the most trusted financial instrument on Earth. Here is why that matters. Every major interest rate in the global economy is priced relative to what the U.S. government pays to borrow. When that rate moves up, everything else follows. Your mortgage, your car loan, your credit card rate, all of it anchored to the 10-year Treasury yield. And for decades, the Treasury market had one reliable behavior in a crisis. When stocks fell, when investors got scared, they moved money into Treasury bonds. Safe haven. It was not a law. It was a deeply held global instinct. Stocks go down, treasuries go up, yields fall, mortgages get cheaper. That playbook held through the dot-com crash, through 2008, through the COVID panic. Every time everything else broke, Treasury bonds held. April 2025 broke the playbook. When Liberation Day hit on April 2nd, the stock market started selling off immediately. The S&P 500 dropped over 10% in days. Trillions of dollars wiped from retirement accounts across the country. But here's the part that didn't make the evening news. Treasury bonds were also falling at the same time. Stocks and bonds going down together. That is not supposed to happen. The 10-year Treasury yield jumped roughly 50 basis points in a single week. The worst weekly move since 1981. The 30-year yield posted its worst weekly surge since 1982. The safe haven market was breaking, and the thing breaking it had nothing to do with the tariff percentages on the chart behind the president. It had everything to do with a financial structure that had been quietly building for years, hidden inside the world's most liquid bond market. Here is the mechanism, and this is the part most financial coverage skipped entirely. For years, large hedge funds had been running what is called a basis trade. Here is what that means in plain English. Imagine you notice that the same Treasury bond, the exact same bond issued by the U.S. government, costs $100.05 in the futures market and $99.98 if you buy it directly in cash. That gap is 7 cents. 7 cents means nothing on one bond. But if you are borrowing $30 for every dollar you actually own, and you are doing this across billions of positions, that 7 cents becomes real money multiplied at a scale most people never encounter. That is the basis trade. Find the tiny pricing gap between two versions of the same asset, amplify it with 30-to-1 leverage, collect the spread. By April 2025, hedge funds had built roughly $1 trillion in these leveraged treasury positions. $1 trillion in the world's supposedly safest market. borrowed 30 times over. Now here is what happens when Liberation Day hits and markets panic. The pricing gap between Treasury futures and cash bonds starts moving unpredictably. Hedge funds receive margin calls. The bank that lent them that 30-to-1 leverage says, "Pay us back now, or we start liquidating your positions." So the funds sell treasuries to raise cash. And here is the feedback loop. When they sell treasuries, bond prices fall. When bond prices fall, yields rise. When yields rise, other funds holding similar leverage positions receive their own margin calls. So they sell, which drops prices more, which raises yields more, which triggers more margin calls. A cascade. In the world's most liquid bond market, the one that always had a buyer for every seller, there were suddenly not enough buyers. The spread between Treasury cash prices and their equivalent contracts hit levels that had never been recorded. Institutions monitoring global stability could see the fracture forming in real time. And within days, 30-year fixed mortgage rates in America crossed 7%, not because the Fed raised rates, not because the economy was overheating, because a trillion-dollar leverage trade was unwinding in the background. And nobody on the evening news explained it. Here is where the official story falls apart. On April 9th, the day the pause was announced, Treasury Secretary Scott Bessent told reporters the bond market had nothing to do with it. It was always the plan, he said, a strategic negotiating move. That same week, Kevin Hassett, the director of the National Economic Council, went on CNBC and said the bond market was, quote, probably telling them it was time to move. Those two statements cannot both be true. And then the president settled it, not in a formal statement, but in an aside to reporters, the way people tell the truth when they stop being careful about it. The markets were getting a little bit yippy. That is not the language of a man executing a planned strategic pivot. That is the language of someone who watched a number move and got uncomfortable. Here is the crack that actually matters. And this is not a partisan observation. It does not matter which party you voted for. A group of hedge funds had built a trillion-dollar leveraged position inside the world's safest market. When that position began breaking, it moved yields, moved mortgage rates, and threatened the stability of global borrowing costs. And that threat was sufficient to reverse a presidential trade policy in 9 days. The funds that built those positions were not punished. They were not regulated out of the basis trade. The people who lost 7 to 12% of their 401k in 5 trading days were not compensated. The homebuyer watching rates spike above 7% got no explanation and no refund. The leverage was private. The consequences were public. Quick note: if this is landing for you, subscribe to American Ledger Journal, Weekly Explainers. And if someone should hear this, send it to them. All right, back to the story. Here is what this means in a real financial life. If you were a first-time homebuyer in early April 2025, the kind of person who had been saving for 3 years, tracking rates, waiting for the right window, that week closed the window. On a $350,000 mortgage, the difference between a 6.7% rate and a 7.1% rate is roughly $96 more per month. That is over $1,100 a year. For a lot of buyers, that is the gap between qualifying for the loan and being told to come back later. If you are 52 years old with $180,000 in a 401k, which is close to the median retirement savings for that age group, you watch somewhere between $14,000 and $21,000 disappear in 5 trading days, not because your fund manager made a bad call, because a leverage cascade in the Treasury market pulled every asset class down at once. If you had a business line of credit repricing in that window, a contractor, a small business owner, anyone with a floating rate loan, every basis point that Treasury yields moved became a basis point more on your next statement. Without warning, without explanation. The funds running the basis trade were not your 401k manager. They were not your pension. They were private capital, running private leverage inside the most public market in the world. When their positions broke, The losses didn't stay with them. They moved through the system, into yields, into mortgage rates, into retirement balances, and landed on people who had never heard the words basis trade in their lives. Here is what the ledger says. The pause on Liberation Day was not a diplomatic victory. It was not a planned strategic move executed on schedule. It was the Treasury market sending a signal so loud that the administration could not ignore it. And that signal was not coming from foreign governments or trade negotiators. It was coming from a trillion-dollar leverage structure quietly built inside the world's safest market by funds that answer to no election and no constituency. The bond market is not a news story. It is the infrastructure behind every financial decision you make. Your mortgage rate, your retirement balance, the cost of every loan you take out for the next decade, all of it priced against a market that, for 1 week in April 2025, the most powerful institutions in the world could not stabilize. The ledger does not care who paused what or why the official story changed 3 times in 3 days. The ledger says this: the thing that stopped the policy was not diplomacy, it was leverage, and the people who paid for that leverage unwinding were not the funds that built it.